Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. I'm going to talk about consumers because the Bank of New York's consumer debt numbers are out. What's going on with inflation and a couple of parts of the country that have legitimate deflation, and earnings and what's going on in the market, which is not very dramatic. A couple of weeks ago, the ISM numbers for manufacturing came out in expansion. That was good news. Manufacturing is coming out of its slump. Service pretty much came out with pretty good numbers too. The manufacturing, the service side, which fundamentally just call that the whole economy, is moving along just fine. If you're looking for a problem there isn't. CPI number came in at 2.4, the core at 2.5. Yes, that was good. That was a good number. It's probably a little incomplete because the data isn't that great. They're still getting better. You look down at the initial jobless claims numbers, they're back up in the 230, 240 number. Compared to how low they got a little while ago, some of that is lack of data because it was shut down and pick a reason. But it is showing normalcy in the job side, normalcy in layoffs, not a lot of issues there. Interest rates, the yield curve looks very good. It's still high on the short end on the 3-month T-bill, still a little high because interest rates are still, where they are. Some would tell you that, the short-term rates are just waiting for the Federal Reserve to lower rates. Well, they may be waiting for a while. I think it's a safe bet they're not going to do anything in the first quarter. Maybe the second quarter, maybe. Running out of impetus other than maybe a political motive to lower interest rates. Frankly, if you look at the federal spending deficit, which is the important side, source of inflation in the U.S. economy is federal deficit spending. If the federal government puts more money into the system than it brought in revenue, that's inflationary. You run a 2% deficit over the years, and you pretty much put 2% inflation into your system. More money, inflation, Deficit spending is going to be, looks like the norm for the foreseeable future, looking at the numbers. And I don't care what Congress or administration is in there, either one of them are going to have deficit spending for a variety of reasons. Well, anyway, so we have, let's call it 2% inflation built into the system now. And if you're already at 2% just in new money in the system, anything else like an increase in fuel or something else keeps that inflation number up. Federal Reserve knows this, and that's why they can't be lowering their rates. The job side of things, employment costs, increase in wages and benefits and all that stuff, that's pretty much under control. What isn't under control is health. Big group policies. They're up 8-9%. Individual policies up a lot more than that. Number of years of the ratio of health costs coming down to efficiencies or whatever it is you want to call it. Right now that's kind of reversing itself. We'll know more about what healthcare is going to do by the time this year is over. Consumer report. You've seen this before. We got about $18.7 trillion in consumer debt. Most of it's mortgage. What's really starting to come out is that student loans are coming back to the fore. The days of forgiveness are over. So though it doesn't add here in the delinquencies that we'll get to here in just a second, that's the source of the delinquencies, the student loans. You look at this is where the delinquencies are. It was doing so great for so long, down at the bottom, and now it's coming back up. Don't view that as bad news. That's normalizing. That most of that is putting student loans that have been long forgotten by people back in the equation. And that's what's happened. You're not going to just walk away from that. That gift is over. This is still not a consumer that's in trouble. This is not a consumer that is buried in debt that they can't get out of. It's just normalizing. United States, if you look at the various areas, West Coast has high inflation, mostly due to fuel costs. Most people are aware that they've got a real problem with gasoline. Not only they don't have very many refineries anymore, they can't get it around. So it's kind of expensive. Down in the Gulf Coast, since they've kind of opened up the market with Venezuela, we've talked about feeding the refineries down there, and Texas itself, the Permian Basin, well, they're actually in deflation. Their fuel is down. Their built-in costs are down. All of the new capital that's come to that state, mostly out of the East Coast, mostly out of New York City, well, it's not inflationary there anymore. That money's been absorbed, and they're in deflation for a while. And New York and the upper eastern seaboard has already had a bad winter. They've got a little inflation, mostly built in on fuel and just staying out of the weather. But this is not a bad inflation environment. Nothing is really out of control, and the whole middle of the country has very low push on inflation. Existing home sales, well, they kind of dropped. They dropped for a couple of reasons. One, the federal government is making noises that they really don't want institutions to be buying single-family homes anymore. They think they don't belong in the market. Well, yes, okay. I don't think a lot of the people in the administration understood how big an impact some people like BlackRock or other institutional buyers had a very positive effect on new home building and developers. They come in and say, I'll buy 20% of all your new units and I get a good price, I'll pay up front. That moves a developer along to build new projects. Homes are not going to get cheaper. They're sold not based on high quality, they're sold based on features. Well, a bay window will sell a house long before good insulation will. That's just the psychology of the consumer. But the affordability problem is not going to be solved by any government action. It's not going to be solved in the foreseeable future. Houses are not going to get cheaper. They're either going to have to get lower quality, which isn't likely, or they'll simply get smaller, which happened in the rest of the world. It just never happened here. Markets still going sideways. We're still a tiny bit overvalued, in my opinion. There aren't any dramas or catastrophes waiting out there or anything really weird. Might have an incident of some kind that would pull it down a little bit, but the buy on dip people are frothing at the mouth for something that would resemble a dip that suggests, boy, it's really time to buy. Frankly, when earnings came out, I looked at that was basically 12% earnings, which is a good number. Had no impact. It's like people are used to it and they expect it now. That's a good number. If that were 2%, market would have corrected. But I don't see that coming. Manufacturing is coming around. Services are coming around. Retail has slowed a teeny tiny bit, but they're showing no signs of dropping significantly. So the market's just going to go sideways here for a while until we get some further evidence. And there was a question about really what percentage of the U.S. economy is labor, is wages, labor, unions, labor, that kind of stuff. Unions is a very tiny percentage, but labor, W-2 income, wages, it's a significant part of the economy, a little over 50%. That's been dropping. As our economy gets wealthier, there's more transactions between people that already have money and don't earn any more. They're just doing transactions with existing assets. And that's becoming more and more the case. Labor as a contributor is dropping, and it's dropped again. I expect this will be a precipitous drop in the next few years. Just another positive sign for the investable markets. Well, that's pretty much all for now. There isn't anything dramatic going on. As always, got a question, send it along at info@shjwealthadvisors.com, and I'd be happy to look at it. Meanwhile, thanks for joining me.